All right, so it is now official. We are going to be seeing the rollout of 25% tariffs on Canadian exports to the US starting on Saturday, February 1st. This was confirmed by President Trump during a press conference yesterday, mentioning that the US is moving forward with tariffing Canada and Mexico, but that for Canada specifically, the inclusion of oil exports in these tariffs has yet to be determined and may be excluded from this first phase of rollouts.
Those tariffs may or may not rise with time.
Will oil be part of that, though? Because we get oil from Canada.
Oil is going to have nothing to do with it as far as I'm concerned. Oil has nothing to do with it.
So what does this mean for Canadians? Well, bottom line, it means higher prices, probably some inflation on the horizon, and a decline in GDP. Not just a slowdown in growth rate like we've experienced over the past decade, right? We covered these impacts in detail in yesterday's video, so make sure to check that out after this one. I'll leave a link in the pinned comment. But in response to this, the Canadian government has also mentioned the implementation of a government relief plan, which will, quote, be there to help support Canadians and Canadian businesses if tariffs were to be imposed, which now we're seeing will be the case.
The president does choose to implement any tariffs against Canada, we're ready with a response.
So we don't know what the scope of this relief plan will be as of yet, but if it's anything like what we saw during COVID, we could expect to see a lot of new money printing to artificially prop up the economy in times of turmoil once again, which realistically is the last thing the Canadian dollar needs to be exposed to right now, devaluing the loonie even further. But rest assured, as soon as the details of this relief plan are out, I'll release a video, so make sure to subscribe to the channel. All right, now in parallel to tariff threats that are now becoming more than just threats, the Bank of Canada has just lowered their benchmark interest rate by another 25 basis points as of last Wednesday, while also releasing their latest version of the monetary policy. And in this monetary policy, they cite a couple of reasons for the dollar being in the gutter, which in my opinion is only really just the start, unfortunately, and there's definitely also a couple of reasons that they don't really mention that I think are impacting the dollar as well, which I'll be speaking about today. So you don't want to miss out on that later in the video. All right, so I've read through most of the latest monetary policy release for January 2025. I won't bore you though with the entire thing, but near the end of it, there's a section titled Recent Factors Affecting the Canada-US Exchange Rate. And right below that, they mention the following. The Canadian dollar has declined against the US dollar since October 2024, mostly due to rising uncertainty around trade policies. A widening differential in policy interest rates between the two countries has also played a modest role. So really, the Bank of Canada is pinning the terrible exchange rate on two main points, being uncertainty about trade policies with the US and rate differentials.
The potential for a trade conflict triggered by new US tariffs on Canadian exports is a major uncertainty.
But despite what the Bank of Canada is saying, here is my take on things. Yes, the tariffs and trade uncertainty between the US and Canada will have a further impact on the exchange rate, but underlying to that, there are other fundamental issues that have been creeping in the shadows for years in Canada that are now being exposed and coming to light at a time when the Canadian economy and dollar are hurting. But before we dig into that, we need to just quickly cover how the value of currencies fluctuates in like 30 seconds. Basically, although economies are highly complex structures and hundreds of variables come into play in regards to currency fluctuation, the bare bones factor behind a currency gaining or losing relative value to other currencies is supply and demand. I know I talk a lot about this on the channel, but it's one of the most fundamental economic principles that applies to many concepts. On a macro level, if individuals and companies find Canadian dollars attractive for buying and holding, its value will rise. However, if demand for Canadian dollars weakens for whatever reason, the currency's value will decline. For example, with the confirmed tariffs now in effect, cross-border business becomes significantly less attractive because it's more expensive for both parties. And as a result, many companies may opt to fully establish operations directly in the US instead of dealing with the added costs and uncertainties of international trade and tariffs every time goods cross the border. This could therefore lead to fewer companies companies investing in Canada in general, employing Canadian workers, and ultimately needing to hold Canadian dollars. So effectively, less dollars being held by companies and individuals means more of that money flooding back into the economy, and it is just less desirable, specifically in parallel to the American dollar in this case. So long term, this could dry up business investment even more than it is already in Canada and lead to even lower GDP figures for the country, basically crippling the economy even further than it's already been trending over the past couple of years, and most likely devaluing the Canadian dollar further along the way. Here's a chart showcasing the business investment per capita in Canada, meaning per person, versus the US since pre-2008, where we can see that it's really in 2015 that the two lines start to take drastically different paths, right? And over time, this would decrease Canadian jobs and decrease the Canadian dollar because companies don't need to hold CAD to pay workers. So effectively, less demand overall for the currency, which is one of several reasons as to why the Canadian dollar is where it's at right now. These upcoming tariffs are really just a nail in the coffin for this aspect of things, but the Bank of Canada seemingly only wants us to focus on Trump and his tariffs as the main reason, even though the trend of the Canadian economy over the last decade and monetary policies that have been put in place are also contributing factors. So let's take a look at that right now. This right here is the current interest rate of the Bank of Canada beside the current interest rate set by the Fed in the US. And so we can see that the Bank of Canada has dropped rates much quicker than the Federal Reserve has. So the question then is, why has the Bank of Canada chosen to lower rates much more aggressively than in the US? Well, it mainly comes down to the Bank of Canada reacting to low productivity figures in the country, especially now with less foreign workers and cheap labor that have been used over the past couple of years to artificially create this sense of increased output in the country, which was also artificially propping up the workforce and the economy, right? The more a central bank or government implement policy to try and shape the outcomes of an economy, the more it tells us that the country isn't doing as well as it probably should on its own if business was booming and GDP was growing steadily from trade alone. The Bank of Canada wouldn't have to lower rates to further stimulate the economy, in the same way that the government wouldn't need to inject dollars into residents' pockets to counter these negative impacts of US tariffs. And so overall, this means that over time, as the Bank of Canada has reduced rates much quicker than the Fed has, it's made bonds more attractive and lucrative in the US than in Canada. So that means more investment dollars once again in the US rather than Canada. And by the way, if you aren't familiar with how bonds work, all you really need to understand here for the purpose of this video is that government bonds are debt securities that are issued by governments to raise funds for whatever purpose they want to use them for, where investors lend money to these governments in exchange for periodic interest payments and the return of the principal at maturity, right, when the bonds come to an end. And government bonds are generally seen as lower risk investments that also create income for the investor. And so as it sits right now though, Canadian 5-year bond rates sit at roughly 2.7%, whereas 5-year bond rates in the US sit at 4.3%, essentially meaning there's a 1.6% positive spread on US bonds over Canadian bonds. And this is one of the contributing factors that the Bank of Canada has alluded to in their monetary policy as being one of the factors impacting the CAD to US exchange rate.
First, inflation has been close to the 2% target since last summer. Monetary policy has worked to restore price stability.
All right, so the bottom line here is that the BOC has cut rates at a much quicker pace to try and stimulate the economy more. But this artificial stimulation has led to certain repercussions in FX rates. Just look at the US GDP figures while their interest rates are still much higher. They have way more overall productive output and growth, but also on a per capita basis than here in Canada. So ultimately, yes, these two factors are contributing to a weak Canadian dollar, but I think there's a bit more to it that the Bank of Canada doesn't really want to directly come out and say. It's more enticing to just point the finger finger at outside factors like Trump, international wars, less productivity overall, rather than also taking responsibility for the very policies that they put in place. Kind of makes you think of one recent video on immigration aimed at gaslighting the Canadian population, but hey, that's an issue for another video. In the world of investing, everything has to do with rate of return in relation to the risk of said investment, generally with a higher rate of return for a higher risk involved. Well, in comes the concept of exchange rate risk premiums, essentially how risky investors think it is to hold Canadian dollars versus US dollars right now or at any other given moment. And with Canada being viewed as a highly unproductive and confused country right now, people have less economic faith in the country than in decades prior. Plus, with Trump now being in place, a lot of people have much higher confidence in the American dollar, gaining further value over the Canadian dollar. I also think it's due to people's just overall view of Canada right now being a second-tier place to invest in, and where the dollar will continue to drop due to inflation as well, which could be the case with these potential relief packages that we've been talking about, which would flood the market with even more cash, devaluating the loonie even further. So this brings up the idea that holding CAD is just more and more risky in general, and to bring things even closer to home with my own investments, I've seen this coming for a while, and therefore 100% of my cash held in investment accounts is actually all in US dollars, which has paid off as I haven't been directly affected to the same extent by the crumbling value of the Canadian dollar. And also for the record, I made videos about this very topic back in August 24 and still got comments like the following. So I'll leave you with this. There's a reason a lot of the Canadian monetary policy focuses on the US dollar and what Americans are doing, even though this is decisions that the Canadian bank is going to be taking. Generally, we try to follow the US in lockstep, but now for the first time in decades, the countries are really starting to spread in regards to where they're headed economically, and we in Canada are the ones on the losing end big time. So what should we do as everyday residents in Canada? Realistically, there isn't much that we can do as everyday residents other than continue to go on about your own business. Try to make as much money as possible and invest as much of it as possible, because we can't really make any impact on who's taking these shots and making decisions for the country, unfortunately. And I know a lot of Canadians are struggling right now financially, so the idea of investing is totally foreign right now. Fair enough, but truly that's the only thing that you can do, is try to increase your skills and your income. There's really no other way out of it. And if you can, try to invest in US positions in the stock market, and also try to hold other investments as well. I personally invest a lot of my capital into real estate, even though that's its own set of challenges, but always try to invest as much as possible and only keep as much as you truly need in an emergency fund, a couple months worth of Canadian dollars if you're in Canada. By the way, if you want to start investing, make sure to check out my 100% free to watch course over on Skillshare on stock market investing. Has over 7.5 hours of video content and 3,000 students. Also, if you want to start investing and you don't have an account, check out Moomoo, links down below in this video's description and pinned comment to get some free money when you sign up and fund your account. Thanks a lot for watching. Check out one of these two videos, subscribe, and I'll see you in the next one.